Hello, everyone, and welcome back to Therapy for Your Money. This episode is part of a two-part series on selling your practice. So today we're talking about understanding the value of your practice and how you can get a high-level estimate of what you might be able to sell your practice for. So I'm going to start off by saying that when it comes to selling a practice, size matters. The bigger the practice, the more sellable it is, and ultimately the higher amount of money you're going to receive for it. A solo practice just doesn't tend to be worth a whole lot. You are able to still sell it. You are able to get some money for it. But when you are in solo practice, really in many ways, you own your job, right? You own a job. You might have some systems in place, a name, a website, some SEO, and a client list, and you can sell that to someone else. But ultimately, they have to get in there and do the work. And so there's not necessarily a huge amount of money to be made there. Even if you are selling your client list, that's great, but there's not ever a guarantee that the clients will transition to the person who is buying your client list. They may not be a good fit for each other. And so because there is that big, huge transition, a solo practice will typically not be very sellable or not bring in a huge amount of money. So what I'm talking about today when it comes to the value of your practice, we're really talking about group practices with at least 5 full-time clinicians, but ideally 10 or more full-time clinicians. Again, it's a size thing. A practice with 5 to 10 clinicians might be sellable, but we're going to have a much lower value than a practice with 10 or more clinicians, because at that size, with 10 or more, you just have to have more systems in place. There's a much higher likelihood that things can run pretty well without the owner being present. And that is going to make a practice more valuable to a potential buyer. So we're really looking at 10 or more clinicians, which ideally will be about $1 million in annual revenue or more. So what's the formula? What is your practice worth? When we're looking at evaluation, we're typically looking at the EBITDA, which is earnings before interest, taxes, depreciation, and amortization, which in the case of most private practices is going to be their net profit. So the profit or the taxable income of the business, that is usually the number we start with. EBITDA is one of those fancy accounting terms, but really in the case of private practice, there's usually very minimal interest, right? A private practice that has significant loans is not going to be very sellable. So usually there's not these big pieces of equipment like a manufacturing business where it's very normal to have a significant amount of debt. That's not as normal in a private practice. Even if you own the building that your practice operates in, typically that's owned in a separate entity. So your practice is not taking out that loan. That's a loan that you might personally have, or maybe you have the building in a separate LLC that has the loan, but that's not usually in your business. Same with taxes. Most private practices are pass-through or flow-through entities when it comes to taxes. That means that the tax burden flows through to the personal tax return where it is then taxed. So the business itself doesn't pay a significant amount of tax. Depreciation is the same thing. We typically will see furnitures and fixtures, maybe some leasehold improvements for the space you're occupying, but there's typically not a huge amount of depreciation in private practice. And so really that's why I'm going to, for the purposes of this podcast, start with net profit. So we want to look at net profit in the business. The higher that percentage is, the better ultimately. There are a few cases where it's too high, right? I'm going to use air quotes there, too high. There are really very few cases where your profit is so high that it is a concern. Usually it's kind of the opposite, that it's a little bit low and that might actually not play to your advantage. So item number 1 in the calculation is your net profit. And then we multiply that by a multiple. And maybe if you've been around the block in your private practice, you've heard other practice owners talk about multiples. So what exactly is a multiple? Let's dig in a little bit. A multiple is going to be a number by which you multiply the net profit of the business to get to the value of the business. There are a lot of different things that affect multiples. One of those is health insurance companies and their whims. For example, if all of a sudden insurance companies said, you know what, we're going to pay $20 less per telehealth session than we do an in-person session. If you have a telehealth practice where you don't have a physical location, that multiple just went down for you because your profit went down, everything else went down, but it is now less valuable. So the multiple is going to go down. Economic conditions have a big impact on multiples. In part, interest rates are going to play a big impact there. If it's really expensive for someone to go borrow money, that means they have to be able to make that money back somewhere else. And that's typically going to be with a lower multiple. So the higher interest rates are, the lower multiples can be. And the opposite can happen as well. When interest rates were really low, we were sometimes seeing much higher multiples than normal. Multiples may also be affected by the importance of key people in the practice and how likely they are to stay. If there are some really incredible, amazing people on your team, that might increase your multiple. And in the same token, if there's a lack of key leaders, that might reduce the multiple of the business. There can also be some compliance or legal considerations. If you are, or your practice is under an insurance audit, a tax audit, Department of Labor audit, that's usually going to reduce the multiple and or make your practice less sellable. And the multiple might also vary pretty wildly depending on the different types of buyers. When you're in private practice, your most common buyers are going to be a hospital center or a large medical conglomerate. It can be a competitor, so a business or a practice across town or somewhere else in your state that's looking to expand into your market. It could be an employee that wants to buy the practice from you and keep running it. It could also be a big tech company. So maybe a tech company is looking for exactly what you have. Their multiple might be larger than that of an employee who is really just struggling to come up with the funds to buy your practice. So they may not be able to value it in the same way. And so one of the questions that I get often when it comes to selling a business is, how do I know what my multiple is going to be? And the real answer is, you often are not going to know far in advance. No matter what I tell you in this podcast episode, your business is ultimately worth what someone is willing to pay for it. That is the truth of it. I wish I could tell you you're always going to get at least this multiple and up to that other multiple. And unfortunately, I can't tell you that. What I can tell you is that in most cases, the multiples that we're going to see are somewhere between 3 and 8 times your net profit. Now, you can't take that to the bank because ultimately, if someone's not willing to pay that, that's not going to happen. But we often see a multiple that is 3 to 8 times. So if you have a net profit of $200,000 per year in your practice, which if you have $1 million practice, that is very possible, and the multiple that you're getting offered is a 5x multiple, that means that your practice is worth about $1 million to that potential buyer. So you could walk away with $1 million. That's a great number, but that is going to be taxable income to you. So you always want to consider taxes. One of the exercises that we do often with our clients when they are approached with an unsolicited offer is go through all the numbers, right? We'll look at, okay, this is how much money you make every year. This is how much you have left after taxes. This is what the offer is, and this is how much you would have left after taxes. Is this enough for you to walk away from your practice? Sometimes the answer is yes. But what we often see especially in the case of an unsolicited offer to buy the practice, is that the dollar amount being offered is just not enough. It's not enough for the practice owner to retire permanently at a young age, right? Especially if they're 35, 45, 55 getting this kind of offer. It's usually not enough money to ride off into the sunset and never work again. And so that means they're going to continue working for many years, but not in their own practice. And that's not always very exciting when you have been a business owner to maybe continue to work for the practice or go do something else or start all over again. And often we also hear from practice owners that will say, well, I love my practice. There's so much potential here. And yes, I am working really hard, but there's so much potential. If I'm getting that offer right now, but I keep at this, I think I can get a much higher offer in 3, 5, 10 years. So I'm just going to keep going. And that is a really valid thought as well. If you've been working on this practice and you know all the things that you have in the hopper, you know what you have built, you know that you'll continue to grow over the next few years, then that can be a really great exercise to do. But then to decide, you know what, I'm just going to keep going. I'm going to turn down this offer and it just doesn't make sense for me right now. That is completely valid if you want to do that. But if you're at a point in your life where you're saying, this is too much, I don't like this anymore, I want to sell, then that is great as well. And I want you to be able to do that. Then you can expect, again, net profit times 3 to 8, somewhere in that range. That is what you're going to have to pay tax on when you get that money. There's also a chance that you're not getting all the money up front. So you want to keep those considerations in place and talk to your accountant. Please, 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 please talk to your accountant if you're getting an offer before you accept it. You want to have an idea of how much you're going to pay in taxes, and your accountant knows your specific situation. They're going to be able to give you a really accurate estimate of what your tax burden will be and how much you will have left to invest, start a new business, go do something else, go back to school, right? Whatever your heart desires, you will know what you are facing. When you are thinking about selling your business, I also absolutely want you to talk to your attorney as well. Do not accept an offer without talking to your attorney and having them review the offer. This is what they do. They will be able to look at things and see things in the offer that you don't see because that is not what you do. And so you definitely want to always make sure that you are talking to your attorney. I also want you to talk to your financial planner if you have one. And if you don't, I think you should find one and talk to your financial planner. And make sure between your accountant, your attorney, your financial planner, they are going to be able to set you on the right course and help you make a really informed decision so that you are in a great situation. But if you don't talk to those 3 key people, you may end up with regrets, which is such a sad place to be when you've spent so much time building this business. Now, if you are interested in exiting your practice, I want you to know I have a free webinar replay available. So if you go to greenoakaccounting.com/exit-replay, you can get access for free to the replay of my exit planning webinar. It is a 1-hour webinar where I go over all of this in much more detail on what it looks like to exit your practice. I go over, again, the calculations of how much your practice is worth. I go through some examples. I walk you through the sale process, what you need to know, the due diligence process as well, and give you lots of different tips and tricks for getting ready to sell your practice, whether you're selling or hoping to sell in 6 months, in 12 months, in 12 years. So go check it out at greenoakaccounting.com/exit-replay for the exit planning webinar free replay. That's all for today. Take care, everyone.